Imagine a company, right, a leader in renewable energy, looks like it's tackling climate change head on. And then bam, today, its stock price just tanks, down 10%, even lower than the most pessimistic analysts expected. So is this just, the market freaking out for a moment, or are we looking at a classic value trap, that cheap-looking stock that's actually hiding some really deep, maybe unquantifiable risks?
Welcome to the deep dive. Today, we're digging into Drax Group, ticker LONDRX. And this isn't just about the ticker symbol. It's really about the messy, complicated world of green energy, the real challenges of sustainability, and, well, how markets react, sometimes brutally.
Exactly. Our mission today is to really unpack what happened with Drax's price today, August 28, 2025. It was a big move. We'll dig into the vulnerabilities, the risks, the stuff a value investor has to look at based on a pretty comprehensive report we've reviewed. And the big question is, can a company that, managed this huge shift from coal to renewables actually outrun the sustainability questions that are, frankly, core to its whole reason for being and its value?
Right. And hey, before we jump right in, a quick note for you listening, please do like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers. And listen, we're covering all of the S&P 500 stocks over the next few months, so members get that priority access. Or if you just want a one-off deep dive on a specific company, just drop us a super thanks. We appreciate it. Okay, so to really get why today's news hits so hard, we need to understand the business itself. Let's start with Chapter 1, Business Analysis. Can you maybe set the scene, walk us through Drax's journey from, big coal plant to what they are now?
Absolutely. It's quite the transformation, central to their story. They run the UK's largest power station up in North Yorkshire. It used to be mainly coal, but as of 2023, something like 60% of their output is biomass. What's really key, though, is how they've spread their bets revenue-wise. Electricity generation, that's the biggest chunk, about $1.5 billion back in 2022. But they also have wholesale and retail that's about $800 million. Energy services, smaller, $200 million. And then biomass supply itself, that's critical, $400 million. So they're trying to build resilience through these different streams, but, well, as we're seeing, it doesn't always insulate them completely.
And it's not just what they generate, it's how flexible they are. You mentioned pumped storage hydro facilities. For you listening, think of these like giant water batteries. They can store energy and release it fast. Why is that so important now with all the wind and solar coming online?
Oh, it's huge. A game changer, really. The more renewables we add, the more intermittent the grid gets. Wind doesn't always blow, sun doesn't always shine, right? So you need dispatchable power stuff you can turn on and off quickly when needed. Drax's biomass and their pumped hydro, they fill exactly that gap. Essential balancing act for the grid. It's a core part of their value in this modern energy mix.
And looking ahead, Drax has these, well, pretty bold goals, like being carbon negative by 2030. How are they planning to do that?
Right. That's where BECCS comes in. Bioenergy with carbon capture and storage. The idea is they burn the biomass, capture the CO2 emissions, and then store them permanently underground. This is how they position themselves for, quote, a zero-carbon, lower-cost energy future. And they're already a big deal, 5% of UK electricity, 10% of its renewable power in 2024. This isn't some niche thing. It's pretty central to the UK's plans.
Okay, that makes sense. Let's move into Chapter 1, Part 2, Industry Analysis. The energy world always talks about this energy trilemma, right? Balancing security, keeping costs down, and cutting carbon. How does Drax fit into that puzzle, especially with that need for flexible power?
Yeah, the trilemma is basically their operating environment. As we just touched on, the shift to renewables creates this huge need for dispatchable power, power on demand. Drax assets, the biomass, and the hydro are kind of uniquely positioned to offer that stability. They're the reliable backup when the wind and sun aren't cooperating.
And that BECCS potential you mentioned, it sounds massive. The IPCC thinks we'll need billions of tons of carbon removal by 2050. Is Drax really placed to grab a big slice of that pie?
Well, that's the potential growth story, isn't it? Assuming they can pull it off technically and commercially. They do have a first mover advantage in BECCS, which is definitely an asset. If the tech proves out and the regulations fall into place, they could be looking at a massive market. The scale is hard to overstate, really.
So how do they stack up against others? If you compare them, say, to Greencoat UK Wind, which is more purely renewables, what differences jump out?
It's interesting. Drax is bigger, more complex, definitely more of an integrated utility, but its stock price, way more volatile. Its beta is 1.22. Greencoat's is only 0.24. Now, for you listening, a beta just measures how much a stock swings compared to the market. So 1.22 means Drax tends to move 22% more than the market average, up or down. That signals higher risk than a pure-play wind farm operator like Greencoat. They also compete with traditional utilities, other biomass players, new green tech. It's a crowded field.
That volatility definitely hints at the regulatory side. You mentioned government support. How dependent are they on subsidies, and what's coming down the track?
Oh, hugely dependent. Profoundly, really. Their biomass operations have relied on subsidies, partly based on this controversial idea that biomass is zero carbon. Now, the current, quite generous subsidy system, that ends in 2027. There's a new transitional support mechanism being negotiated right now. It's meant to bridge the gap, but everyone expects it to be significantly less money than they get now. That's a major uncertainty for their future profits. Plus, running these plants takes huge amounts of capital, which does keep some competitors out, but it's still a big cost.
Okay, let's pivot slightly to Chapter 1, Part 3, Competitive Advantage. Drax has definitely built this image, this brand, as a renewable energy leader. But how solid is that really, especially with all the criticism and these investigations we're hearing about?
It's a mixed bag. On one hand, yeah, their operational scale is enormous, huge economies of scale. They've got this global biomass supply chain, long-term contracts for about 75% of their wood pellets, giving them some cost certainty, and that first mover position in BECCS. That's a unique asset for the long term, but that brand is constantly under attack. And that brings us right back to today's news.
Yeah, and this is where, as you said, the plot really thickens. This FCA investigation announced today, August 28th, 2025. I'm looking at their past statements on biomass sourcing disclosure rules between 2021 and 2023. And it's not the first time, is it? They got hit with a £25 million fine from Ofgem, the energy regulator, just last year for misreporting data.
Exactly. This isn't just, bad press. It feels like a pattern. And it strikes right at the heart of their value proposition. These probes, especially the FCA one now, challenge the integrity of their whole operation specifically, where they get their biomass from, which underpins their renewable label and the BECCS plans. The market's reaction today, that steep drop, it shows deep concern that this scrutiny could actually unravel the whole investment case built on that carbon-negative future. This feels fundamental.
That regulatory heat naturally makes you look at the leadership. Let's move to Chapter 2, Management Evaluation.
Well, the CEO, Will Gardner, he's been very public defending their biomass sourcing, arguing it's sustainable, but that public stance is looking increasingly difficult against this backdrop of regulatory challenges. You've got the 2024 Ofgem fine, this new FCA probe, and there was even a settlement with a whistleblower about alleged misleading claims on biomass. It's a string of events.
So, connecting those dots, what does this pattern suggest about their governance, their data management, even if they say they're cooperating fully with the FCA now?
It suggests, at minimum, a history of sailing close to the wind on controversial issues that directly impact their credibility. And in the green energy space, credibility and transparency are paramount. For investors, this pattern, it erodes trust. It makes you question the reliability of their data, their reporting, maybe even their whole sustainability story. It's more than just fines. It's about confidence.
Okay, let's switch gears slightly within management. Let's look at Chapter 2, Part 2, Capital Allocation. Have they been smart with their money, deploying capital effectively?
On the face of it, yes. They seem disciplined. They invested, $332 million in capital in 2024? That went into things like new pellet plants, upgrading their Crew Watch and pumped hydro facility. Those look like sensible long-term investments.
And they've been pretty generous returning cash to shareholders too, right? Big 300 million share buyback started last August, plus a growing dividend. 26p in 2024, expecting an 11.5% increase for 2025. And their return on equity looks strong in 2024, over 26%.
Yes, and this is where it gets, a bit curious, maybe telling. Their latest results, first half of 2025, actually showed adjusted EBITDA and profit falling. Yet management is pushing ahead with these big buybacks and dividend hikes. How should you, the investor, read that optimistically? Maybe management sees through the current storm, thinks the stock's a steal, and expects things to clear up skeptically. Maybe it's more about propping up the share price, keeping the big institutional shareholders happy while these major risks loom large. And the fact that insiders, management themselves, own very little stock, only 0.7%, adds another layer. Less skin in the game, as they say.
Okay, let's get into the numbers. Chapter 3, Financial Analysis. What are the key metrics telling us about Drax right now?
Okay, so market cap is around $3.3 billion US, which is roughly 2.43 billion sterling as of today.
Revenue. Looks like a bit of a roller coaster. Decent growth over 5 years, almost 38% cumulative, but recently. down sharply. Over 22% decrease in fiscal 24 and another nearly 32% drop in the first half of 25. That's quite a swing.
Yeah, volatility is definitely part of the story. Profit margins have also fluctuated. Gross margin is around 28.2% for the last 12 months. Net margin about 10.1%. Respectable, but again, consistency is the question mark.
And free cash flow yield, 9.63%. Looks pretty good on the surface. That's the cash generated versus the company's market value. But then you look back over 5 years, and the average annual growth in that yield is actually negative 0.7%. So does that suggest the recent strength might be, I don't know, temporary?
It could, yeah. It suggests you need to look beyond just the snapshot figure. Financial stability, it's a mixed picture too. Earnings per share have been all over the place. Negative in 2020, then up to 1.35p in 2024. Makes forecasting tricky. On the plus side, their debt looks okay. Low net debt to adjusted EBITDA 1.1 times in the first half of 25, 0.9 times end of 24. So they're not drowning in debt.
Despite all that up and down, the dividend has been pretty steady, even growing.
Right. Now, when you try to put a value on it, Chapter 3, Part 2, Valuation Analysis, doing a discounted cash flow, a DCF model on Drax is tough, mainly because of that subsidy cliff in 2027. You have to make big assumptions. Conservative growth, maybe 2-4% based on history, optimistic, maybe 5-7% banking on BECCS really taking off, and your discount rate, reflecting the risk, needs to be fairly high, maybe 8-10%, given that 1.22 beta and all the risks we're talking about.
Yeah, that makes sense. So it's no surprise then that the analysts are all over the map. Their price targets range from 689p right up to 1000p, median around 730p. That huge range just screams uncertainty, doesn't it? Tells you how hard it is to pin down a fair value right now. Okay, let's shift to how the market feels about all this. Chapter 4, market sentiment. How's the city viewing Drax before today, at least?
Well, before today's bombshell, the general vibe among analysts was kind of hold or outperform. That median target of 730p suggested, a bit of upside from where it was trading yesterday. Cautious optimism, perhaps?
But that feels like ancient history now, doesn't it? Today's 8-10% plunge, media's linking it directly to the FCA news. It's not subtle. It just reinforces this negative story about compliance problems, and the market's clearly voting with its feet.
Yeah, and what's really telling is the short interest. It was surprisingly low, just 1% back in July. That strongly suggests this FCA probe wasn't really on the radar for most professional investors, the short sellers. It was an unexpected punch. The market genuinely seems to have been caught off guard by this, or at least by its severity.
And technically speaking, the stock was actually looking okay, trading above its 50-day and 200-day moving averages, around 600 and 9700p. But today's drop to 630p smashed right through both. For chart watchers, that's flipped from a potential buy to a pretty definite sell signal.
Absolutely. Today's reaction isn't just noise. It's a significant re-rating of Drax's risk. The price falling below those technical levels and below even the lowest analyst target of 609p. That signals a fundamental shift. The market is saying this FCA investigation is a serious, potent risk, more than just a blip.
So who actually owns the stock? Let's look at Chapter 5, ownership structure. Does that give us any clues?
It's heavily owned by big institutions, over 70%. Think BlackRock, Invesco, Schroders, the big players. Usually you'd see that as a positive sign. Confidence from the smart money.
But conversely, insiders, management, and directors own very little, only 0.7%. For you, the value investor looking for alignment, that's often a red flag, isn't it? You want them eating their own cooking.
It can be, yes. Though, countering that slightly, management is using company money to buy back shares pretty aggressively. That $300 million program started last August, and they were still buying shares this month, August 2025. So in a way, that's a form of insider transaction showing confidence. Even if it's not their personal money, it supports the price.
So pull that together. What kind of picture does it paint? High institutional ownership, low insider stakes, but active buybacks. What are the incentives here?
It paints a complex picture. You've got the big institutions providing some stability, maybe. But the low insider ownership combined with these big buybacks and dividend hikes, especially when profits are falling and risks are rising, it could be genuine belief the stock's cheap, or it could be a strategy to keep those crucial institutions happy, maintain support, maybe shore up the price against the bad news. It's nuanced, not a clear-cut signal either way.
Okay, time to really stare the risks in the face.
Yeah.
Chapter 6, risk assessment. Can you give us a quick SWOT analysis? Strengths, weaknesses, opportunities, threats.
Sure, let's break it down. Strengths, scale, biggest UK power station, vital electricity supplier. They're a leader in BCCS potential. And the balance sheet looks solid, low debt relative to earnings. Good foundations.
Okay, weaknesses. What could undermine those strengths?
Big one is the supply chain reliance, that complex biomass sourcing, mostly from North America. Vulnerable to logistics, politics, price swings. This also fuels the ongoing reputational headaches. And as we've seen, financials can be pretty volatile.
Right. But on the flip side, opportunities look pretty big too.
Absolutely. The global need for carbon removal. BECCS is aimed right at that. Huge potential market. They're looking at new things too, like sustainable aviation fuel. And that government transitional support after 2027, even if it's less money, it's still support potentially.
Okay, but now for the big one, especially today, the threats.
Mm.
What are the most pressing dangers for Drax right now?
Number one, without a doubt, is this FCA probe. It's not just fines. It's the reputation hit, the loss of confidence. It's immediate and material. Then there's the whole subsidy uncertainty post-2027. The government's already signaled lower volumes of support. Add in macroeconomic stuff, biomass prices, shipping costs, and geopolitical risks like maybe U.S. tariffs impacting their supply chain. Lots to worry about.
You said earlier the FCA probe fundamentally shifted the risk profile. Why is this investigation such a big deal, turning perception into a primary threat with real financial consequences?
Yeah, because look, criticism isn't new for Drax. They've managed it. But this FCA probe, it's different. It's official. It's about the integrity of their past statements on biomass sourcing. That's core to their green claims. It moves the issue from, NGOs complaining to potential regulatory enforcement, fines, legal costs, sure. But worse, it could jeopardize future subsidies. It could cause ESG investors to bail, questioning if Drax is really green. After all, it's a keystone risk. Pull that stone and other things could start to crumble. It challenges the very foundation.
Okay, let's try and wrap this all up. Chapter 7, conclusion. What's the final bull case versus the bear case here?
All right, the bull case. Drax is critical infrastructure for the UK. Huge scale. Leader in potentially vital future tech like BECCS and SF. Strong balance sheet. Big institutions own it. They return cash to shareholders. Position for decarbonization.
And the bear case. Just as strong, maybe stronger today. High political risk, high regulatory risk, high reputational risk. Dependent on controversial subsidies that are changing. This really serious FCA investigation hitting their integrity. Volatile earnings, low insider ownership. And yet today's violent reaction from the market tells you investors are deeply worried these risks are becoming very real, very fast.
Valuation-wise, we mentioned that wide analyst range, 689p to 1000p, median 730p. Reflects optimism, sure, but also huge uncertainty.
So for you listening, what does it mean? Today's price, around 630p, way below even the lowest analyst targets. Does that mean the market's lost its head, overreacting? Or have the analysts just not caught up yet? Have they not fully baked in the severity of this FCA risk?
Look, the long-term potential in BECCS is definitely there. It's significant. But getting there, the path is full of political hurdles, regulatory landmines, which makes today's stock price look very much like a potential classic value trap. Looks cheap, yeah. But the underlying business model, it's facing fundamental risks, systemic risks, that are increasingly outside of management's direct control.
So what stands out to you about where Drax is right now? How much risk are you comfortable with for that potential future reward when the present looks this uncertain, this scrutinized? This deep dive really shows, doesn't it? Even in green energy, the road to sustainability, to success, it's rarely straightforward, often pretty bumpy.
It's definitely a powerful reminder. You have to look at the whole picture, the scale, the tech, yes, but also the regulations, the governance, the controversies, all of it matters for an informed decision.
Well, thank you for joining us on this deep dive. Please remember to like and subscribe to the Stock Analytics AI YouTube channel for more analysis like this one. Members get priority on ticker requests, and we are covering the entire S&P 500 soon. Members get that exclusive early access. And hey, if you want a specific deep dive, just drop us a super thanks. We really appreciate the support.
And just that crucial reminder, this analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Please, always do your own thorough research or talk to a qualified financial advisor before making any investment decisions.